and welcome back to another Macro Mondays. My name's James Brodie, and today I'm joined by Harry Nedeljkovic.
Hello, James. It's great to be on. I'm a research analyst here at Onyx. And James, what's been going on this week?
Well, we've got plenty to discuss this week. We have 14 or 15 charts. We'll be talking about payrolls last Friday, how the market reacted to that. Really good chart, the US 2-year. Euro dollar, big moves in gold as well. Anything else, Harry?
Yep, we've got a bit on the EU's recent elections this weekend, in addition to some, GameStop's actually been an extremely interesting one as well.
Yep, couldn't have a Macro Mondays without GameStop. So let's crack on with last week's data. Mixed data in the US. It started with a very weak ISM manufacturing index last Monday, coming in at 48.7, showing contraction well below expectations. Probably the key point of that was new orders index collapsed to 45.4. Then on Wednesday, on the other hand, the weak manufacturing was followed by strong ISM services data. This jumped above expectations to 53.8, and here you had a higher than expected new orders, 54.1. Again, the service sector is about 3 times larger than the manufacturing sector. But of course, the manufacturing sector is what has the bulk of the demand for commodities like oil, which we'll be discussing a bit later. Throughout the week, we had some employment data. It all looked pretty bleak, as we'd seen in previous surveys. The JOLTS job openings index came in much weaker than expected on Wednesday. The 4th sharpest decline since 2000. We had a weak ADP jobs data as well. Then Thursday's jobless claims and continuing claims were also weaker than expected. Then what we had on Friday was US payrolls. Market was expecting a lower number than expectations, around 180,000, but it jumped to 272,000. Jobs created last month, much higher than expected. This took the market by surprise. Yields ramped much higher, and also the dollar strengthened aggressively. Of course, what the algorithms do, they trade off the headline and the market reset immediately. But when we drill down to the data, firstly, the unemployment rate rose, unexpectedly rose to 4%. But underneath, again, we saw more of the same. It was all part-time workers. In fact, full-time workers' jobs lost was 625,000 jobs lost. Part-time workers' jobs created was 286,000. There's a big estimation involved as well in the birth deaths rate. So over the weekend, as the market digested this data, it wasn't seen as such a strong headline. In fact, also the number of people working multiple jobs in the US is near a record at 8.4 million. And that's a jump of 3 million since the pandemic lows of 2020. Also, what hit the headlines, in May alone, 414,000 immigrants gained a job, while native-born Americans, 663,000 lost jobs. The chart we have here, you can see this is the pool of available labour. You can see the pool of available labour, that's now starting to go up quite aggressively. So it seems like the headline, in my view, was a bit of an anomaly to all the other data we've been seeing in the last week. Any thoughts on that, Harry?
Well, yeah, as you were sort of saying, it's far less of a positive, it might be far less of a positive indicator than we initially thought. And basically the further you drill down, the less it really seems like there's a rosy outlook for the US, especially with GDP data, with inflation data. It's just not looking as good as the stats would suggest.
Yeah, absolutely. I agree completely. The key, though, point, the algorithms and the market trades off the headline. It's only later when they digest the data that we look into this much deeper. In fact, here, if you look at the charts, immigrants are completely supporting the labour market. You can see here foreign-born jobs created as opposed to Americans losing their jobs. And I'm sure this is going to become a bigger issue as we go into the election, the border, and of course, as we're seeing in Europe over the weekend, When people start to lose their jobs, they become more upset about immigration. Big chart really here, the 2-year bond yield. You can see, I think this is a great chart. When you get converging trend lines, volatility is falling, the 2-year yield, what the market does, it simply waits until it breaks. The flip side, the two sides of the story, will it break lower? Well, that would indicate, of course, the US economy is slowing, but we're also seeing a fall in demand for treasuries. And that could be the reason that yields could break higher. We also have CPI this week.
Just going to ask, so how significant is this chart usually, or how significant is this data as like an implication for broader trends?
I think this is really important for technical traders. Fund managers would look at this as well, because at the moment it's going sideways. It's waiting for direction. And when one of these trend lines breaks, that's when the momentum changes. Because stops are triggered, and a break higher or break lower, then you see new trades instigated. But you also see, of course, the algorithms, trend following, which is now such a significant part of the market. They jump on the trend. So again, the 2-year bond yield, it's a converging price action. When it breaks, the resistance is at 5%. A break above that, we'd see an aggressive move higher. Support is at 465. A break below there, we would see an aggressive move lower. Personally, as we're discussing weaker US data, I think it's going to break lower, but again, treat that with a pinch of salt. That's just my view. The key is the price action. The only arbiter of your P&L is the price. So on to the European elections. I'll pass this to you, Harry.
Yes, absolutely. So over the weekend, there was an EU-wide election. These happen every 5 years, and there's around, I think the EU population is sort of around 440 million. So really just a huge electorate. Obviously, the UK has left since the previous EU election. That the Brexit party at the time became the largest party in the UK, actually continuing from UKIP. This election saw kind of similar trends, but from the countries that form the EU now. So the way to really sort of assess that is to see Identity and Democracy is the alliance in Parliament who have, people argued, done the best. I'd be slightly skeptical of that, just because given how the EU, given how they elect their representatives, essentially the vote share that they get is determined by proportional representation, meaning that whilst they might be slightly overrepresented in like national elections, given the strength of the centre in European elections, they still have quite a small vote share. So Identity and Democracy got 58 seats, or a forecast to receive 58 seats of the 720 in the EU Parliament. What's interesting, building on that, is the non-inscrits section as well. So non-inscrits is essentially people who, or parties who are not belonging to a major alliance. This has really grown in recent times. So parties like the AfD in Germany, who came second overall in the country, in addition to Fidesz in Hungary, who have been the largest party for a long time. Those parties are no longer part of an alliance, but I'd say treat the alliance system with a pinch of salt now, because non-inscrits are also quite important. But the other big story is the centre, and especially the centre-right, EPP, the European People's Party, have actually done pretty well. So whilst the Socialists and Democrats have reduced their vote share, along with the Greens, the centre-right has sort of managed to maintain a decent amount. And building on this, so given Emmanuel Macron and his party Renaissance in France, given their really poor performance in the election, where the National Rally, fronted by Marine Le Pen, did extremely well, he called a snap election in the last, I believe it was sometime yesterday evening, which means that France will have a parliamentary election in the next month. I believe it's scheduled for the 30th of June, which really could lead to a huge variety of different outcomes.
Are people highlighting their discontent here?
They certainly are, for a variety of reasons. And, well, I mean, we see in France how there are regularly huge sort of protests. And looking at the polling figures for that election, it could be genuinely huge. So Macron's party has really had just under half the seats for the last, I believe it's 2 years since the last legislative election. But Marie Le Pen's party is currently about 89 seats. And the biggest one is the far left. So the far left coalition got almost, I believe it was like in the mid-teens in terms of percent last time, but they're currently forecast to be maybe mid-20s. And they could be the largest.
And is this content with government or content with immigration or content with both? Discontent, I should say.
It really could be a big combination. I'd say it tends to be regarding economic policy, but inflation has just been a sort of huge aspect of the last really like 2 to 4 years. So since COVID, inflation's just, whilst going away, people are still feeling the effects.
Yep, for sure.
But the issue of immigration is obviously like we're not going to get such huge swings to the extreme generally in Europe without a real conversation about immigration. As an example, for the upcoming UK election, one of the main reasons that I believe the Conservative Party is suffering so much and that they're really sort of hemorrhaging support amongst their vote base is because as the chart you can see shows, that actually shows pure immigration, not net migration. And immigration itself has skyrocketed since Brexit. So in about the last 3 years. And as a sort of, as a going figure, you could argue that for every one EU or European Economic Area, EEA, migrant there formerly was pre-Brexit, there are now 3 non-EEA migrants.
Wow. I didn't realise that. That's a big number.
It really is. It's around 1.2 million immigrants arrived in 2023 and 2022. So, I mean, everything to do with housing crises, everything to do with public transport.
And that's going to bring the Brexit discontent back.
It really is. And essentially, as a function of that level of immigration, so I mentioned to you earlier, just a stat I found recently. Apparently, when addressed in dollars, UK GDP has risen 17.5% since 2007, but UK GDP per capita has fallen by around 8%. So essentially, all of the UK's growth has come from massively increasing.
So what looked like good data is not good data at all. And I've seen that highlighted in Australia as well. GDP per capita is falling aggressively since 2020.
Yep.
Excellent. Let's move on. Some interesting charts here. We have CPI is the key data this week coming out on Wednesday with the FOMC as well. Again, the FOMC, they're not expected to move rates, but it's all about Powell's speech afterwards where he will wink to the market whether they're more hawkish or more dovish. But with CPI, key data this week, 2-year inflation expectations of the US are back to their lowest levels since the start of the year. ECB cut rates last week as expected, 25 basis points. Bank of Canada got 25 as well, and also the Danish Central Bank. So OIS pricing by year end, we now have 36 basis points of cuts priced by the Fed. Just a 60% chance of a cut in September. Some major banks were looking for a hike possibly as soon as next month. After Friday's payroll data, these have been pared back. Again, I still think that's pretty slim. What I find amazing is there's less cuts priced in by the Bank of England, just 34 basis points priced by the OIS, by the Bank of England this year. 37 by the ECB after last week's cuts, and of course Bank of Japan, market's still looking for one hike, just 24 basis points of hikes priced this year. Another interesting chart I found as we've been talking about US housing inventory and the housing market. US housing inventory is rapidly rising, particularly you can see Florida housing inventory year over year is up 70%. Arizona, it's up 68%, and Washington State up 52%. Again, housing market typically rolls over when people are forced to sell, which is when unemployment rate starts to rise. Unemployment rate, it started to rise, and that typically, unfortunately, trends. Once it starts to go up, it typically keeps going higher until the Fed have done a series of rate cuts. On to European data, some key data last week. German unemployment is near COVID highs. German industrial production fell 3.9% year on year, and this remains 15% lower than the peak in 2017. In fact, this morning we've had Italian industrial production. This has fallen 1% month on month. Again, my view, I'm pretty dovish. I think central banks need to cut more aggressively. And certainly G8 economies, manufacturing base is slowing quite aggressively.
Just as an example of, well, as I was talking about before with the implication of these sort of trends on political preferences. So Germany's a really, really interesting one. So I'm not sure if you've seen the sort of map of where people vote for various parties, but in the East, which is far more reliant on industry and obviously was a separate country until 1989, I think. The AfD does extremely well in the East, whereas the West is generally more CDU, which is far more central. They're far more centrist, like centre-right. So if these sort of trends continue, we would really not be surprised if we see extremist parties continue to sort of build support, given their livelihoods are disappearing. I mean,
this has been a theme in Northern Europe. I'm thinking around Belgium and Holland, really for 2 or 3 years now.
Oh, absolutely.
Interesting chart here as well. Default rates in Europe, these continue to rise. On to Brent. Interesting chart here. We had the biggest increase in speculative shorts in 11 years. I find this interesting with people talking about OPEC and cuts, the unfortunate Israel-Iran events, Israel-Hamas, and also Houthi rebels, plus of course Russia-Ukraine.
Yeah, so I mean, it isn't even the biggest increase in shorts in just 11 years. It's at least that. So this could potentially be far longer. But as a result of this, so we saw net positioning in Brent. So that's the ratio of essentially long positions minus short positions. This declined from 141 million barrels in the week to May 28th, to 37 million barrels in the week to June the 4th, which is the most recent data available, which is really just a huge, huge change and is the lowest net position we've seen since 2014. It really can't be overstated how major this is. Brent fell to as low as $76 last week. The EIA reported a 1.2 million barrel build when over a 2 million barrel draw was expected in US oil inventories. Really, really a bearish indicator. And combined with that, so as James mentioned, the OPEC meeting last Sunday really sort of provided another bearish indicator for the market, as essentially production cuts were extended, but that revealed that members of OPEC Plus really wanted to increase their production going forward, and there wouldn't really be this given how the cuts will taper off. We now know that production will begin to ramp up over the next sort of year.
I find it interesting that there's such big short position in Brent when you're seeing such big long positions in the metals as well. Copper,
very interesting, yeah.
Silver, gold, amongst others. Keep pushing on to gold. We talked about the gold moves aggressively higher last few weeks, gold and silver. But on Friday, suddenly we had the headline, China's central bank, PBOC, has halted gold buying of reserves after an 18-month stretch. All of a sudden, gold fell 3.5% and silver fell 6.8%. You can see here, gold is sitting right on support. GameStop, well, what's happening in GameStop?
What's not happening in GameStop? So obviously GameStop was one of the meme stocks that got absolutely, it just rocketed a couple of years ago after, I think it was the subreddit, what was the name? Wall Street Bets.
Yes.
Yeah.
Keith Gill, Roaring
Yep.
Kitty. Roaring
Yep.
Kitty. Yeah.
Keith Gill, also known as Roaring Kitty. The news this week was that he had his first live stream in 3 years, where he essentially revealed that he'd bought $116 million of the stock. During his live stream, I found it really, really funny. Something that you mentioned previously about headlines that algos trade on. There's a clip from, I think it's the end of one of his live streams, where essentially he waits and then says, "I'm ending the live stream," and immediately it drops by 2%.
What's he doing? What's he doing to the market?
He knows what's going to make a difference.
Absolutely. So I didn't see it live, but I read that he was laughing and drinking beer while he apparently lost $200 million. Nobody laughs while they lose $200 million. He's a CFA. He knows exactly what he's doing, and he's, what's the right word here? Leading the market.
He really is. I mean, GameStop rose to, I believe it was just over $48, and it's already down to 28.
Yep. So you're a little bit younger than me, Harry. Would you trade this?
Only if it was money that I definitely didn't need.
I wouldn't touch it because you're just trading off headlines.
Yeah.
That's why I wouldn't touch it. And we'll come to what I would look at. The next chart, the NASDAQ. Here you can see it's broken up. Key support is, well, the previous high really, 18,440. Something I look at is just simple moving average. Here's 8-day moving average. This it's a cheap way of trying to interpret what the CTAs are doing, the trend following algorithms. But you can see what trend following does. It buys when it's going up, sells when it's going down. Trend following makes money because it's never on the wrong side of the trend. Again, you'll bleed money when the market goes sideways, but you will never, ever, ever be on the wrong side of the trend. So again, NASDAQ, it's trending higher. NVIDIA, another one trending higher. I think this is extremely expensive. But again, I wouldn't use a trend following now on this, simply because when it moves down, you're going to get such an aggressive move. I've mentioned before, I don't have a position in it. If I did, I would have trimmed that position, and then I would just watch closely for any break lower.
Yeah.
But again, as you can see here, clearly what trend following does.
And I believe it passed, I think it was $3 trillion in market cap last week.
That was a good point, actually. NVIDIA, Microsoft, and Apple are now bigger than the Chinese stock market. Is that a bubble?
I mean, it'd be hard to argue that it can... As I'm sure people have been saying for a long time, though, it'd be really hard to argue that it can rise that much further.
It's expensive. I think what I say is it's expensive, but it's going up. But definitely what's going to happen, we've seen it with Tesla. When it breaks lower, it will break aggressively. That's the big risk to the market. Key support here, 116 and 96.
Because, of course, they had their stock split as well. So that was...
Friday.
Yeah. So I was going to say formerly that would have been like a $1,100, $1,200, but now not anymore.
On to chart of the week, euro dollar. Euro dollar broke lower. Again, structurally, I think Europe's weaker than the US. The market reacted strongly for the dollar on Friday with the payrolls. Again, Macron and the election over the weekend. The biggest 2-day move lower since September. But we've got here is another converging trend lines. It's getting a triangle here. It's getting narrower and narrower and narrower. These are great to trade by, I say trade, hardest thing here is to sit on your hands and wait till it breaks. Right now, but the key support line comes in at 109.15. But right now, with the data, I would be short and I would add on a break below 109.15, where it will break aggressively lower.
Just to add to that as well. So I completely agree in the short term. Essentially, I agree with your view about structural European weakness, and really looking longer term. Whilst we can talk about like plenty of these indicators, well, economic indicators, I think the biggest thing that doesn't really get addressed with this is the US has really robust demographics. So because of their ability to essentially assimilate immigrants and still maintain quite a high birth rate, their economy is just doing extremely well. It's extremely innovative. However, Europe is just suffering. So Europe's population has been declining for quite a few years now, and it's really hard to see how that would ever change. So the sort of structural weakness that brings will only add to your point.
Also, as you say, US is extremely innovative, and Europe is just hamstrung by regulations, especially France.
Oh, it's I remember seeing quite a few tweets actually from EU Parliament members, EU Commission members, where they post almost like a celebration of passing a new regulation on something. And the equivalent in the US seems to be something along the lines of, we've just invented something, or this stock's just risen above this amount.
In the US, we keep seeing the Teslas and the Nvidias, but we don't see any of these new companies emerging in Europe, apart from, of course, one in Denmark.
Yes, Novo Nordisk is doing outrageously well.
I couldn't pronounce it, so I'm glad you did.
No, it's I think it's above 600 billion now in market cap, but just sailing above. I think the only other company that can really be considered comparable, although not necessarily innovative, is LVMH in France, just purely for value. In fact, actually ASML too, so the Dutch semiconductor, actually I can't remember the exact words, but they essentially build machines that are required for any really advanced chip production. They're the only company that I'd consider competitive with the US.
Yep. Excellent. So on to this week's data. Tuesday, we have UK employment data. Wednesday is the big day. US CPI expected to come at 3.4%. With inflation data, quite often it comes in bang on, and it's pretty unexciting. We also have the FOMC. What will Jeremy Powell, the Fed chair, say? UK GDP. Thursday, we have US PPI, and then Friday, Bank of Japan. No change expected there. And also Michigan US Consumer Sentiment Survey. That's all from us. Have a great week. Thank you.